Thank you everyone for joining us today. This is our third monthly webinar. So far we've had great reviews. People seem to be happy with them. And of course we will have recording available if you need to get hold of it afterwards, or you want to send to a friend, or just take another look and pick up any points that might have come across in that, after the event. Quick intro to us. We are Rick and Andrew from Deal Leaders International. We are sell-side advisors in the M&A space, and we've exclusively sell-side. It's where we focus. We are moving into a world of helping with growth as well, helping with readiness, and we can maybe some of that will come into this discussion today as well. And I think also maybe just a bit of context for this session. We're pretty relaxed. It's a chat. We'll really welcome any questions you may have. I think if those of you who know us or get to know us realize we're about reality. We're not about overly fancy. We're about doing the right thing at the right time to do the right deal. And hopefully that comes across in the way we talk today, and hopefully there's some good nuggets, good learning points around the topic of the day, which is when's the right time to sell? And certainly wait and see is not a strategy. Andrew, I'm just going to kick off with a couple of things, and I'll have a question for you in a minute. But I wanted to start with just setting some context, because typically when people think kind of when's the right time to sell, they think it's all about the market. When's the market going to be ready for my business, and how do I time the market? But there are another two very important factors, and one of them is you, the business owner. And the other one, of course, is your business, because you might be ready and your business not. Your business might be ready, you're not. And of course, then can you time the market? I'm probably going to leave the market one as the toughest one, or maybe the easiest. It's just not that easy to time the market. But I think for you, the owner of a business, it is about things like risk. Can you keep investing in your business? Is that the right wealth decision for you as an owner to keep investing in growth? And of course, do you have the energy to grow? Do you have the focus to grow? There's nothing worse that we find when we can see that people have kind of disengaged from a business, and now they want to sell it. Well, that's the wrong time. You need to be engaged. You need to be focused, but ready for that exit coming ahead of you. And maybe just in terms of the business, the timeline around the business, how long is it going to take to get it more ready than it is today? Obviously, a very, very important question. And of course, the valuation. If you know that you need X, but you're only going to get X minus Y, well, best you get the value up to X. And so there's a lot of, the timing isn't that simple. The timing is about you, it's about your business, and to some extent, it's about the market. But maybe that's just as a context. So don't think that this is all about how do I time the market. It's a lot more involved, and it comes down to you and your business. Andrew, I don't know if you want to just kick off with anything. I know we were going to talk a bit about the power of valuations in this as well, but maybe a quick intro from you.
Yeah, sure. So again, thank you everybody for joining us. I think, building on what Rick opened up with, it's so important to understand as a business owner where you are, and valuation is one component. And I think too often the individual is ignored as the business owner, and that really only comes up towards the end of trying to conclude a transaction, in understanding what it is that you really want, and and how that's going to show up. But it's important to split the two, and I think that's where we've evolved as a business. And really, it's Rick is right. It's impossible to time the market. It's also impossible, I think, to effectively window dress your business to sell, do a quick and nasty to get it out there. And the market generally plays out. It may take longer than not, but fundamentally, if you are ready as an individual in a business, I think your probability is significantly higher. So what we hopefully through this discussion will be able to share is what happens when you peel away some of the layers, and what is the benefit of understanding that, and how that then leads into what ultimately is the right time to approach the market.
Just an interesting thought I had. I've been doing this. I've done a lot of other things. I've been a bit of a checkered career, but I've been doing this for 12, 13 years now. I've never been in a market where there aren't buyers. So that's not the problem. Finding buyers is never the problem. Yes, there may be times when valuations are slightly higher or slightly lower, but we're busy concluding a deal now at a 6.5 times EBITDA multiple in a manufacturing and distribution business. People said the market was flat. Well, that doesn't sound too flat to me. So it isn't about timing the market. It is about all of those other factors.
It is, and I think it's ultimately, I suppose if you coming out of the Olympics, let's just say one uses that analogy, it's, the race is there. You can get into the race, and based on how hard you train, the results will come. What the market readiness is and the timing is about how well prepared are you. And it's not about well prepared for a 50-meter sprint, it's for the 1500 meters. And I think that's what's key here, because you are right. We've never had a situation where through the process you haven't found good buyers. And that call I just got off now from Australia, we've got 5 offers ranging from 300 million to 560 million. It's a huge spread. Why? Because the fundamentals of the business are right. And I think that's hopefully what we can lead into now.
Yeah, I think maybe Andrew, you can tell us a little bit. So often in the world, people think, well, let me do a valuation. But I think the logic of the valuations is wrong, isn't always there. Obviously, one needs to know what the value is so that that it's kind of worth going to market. But tell us a bit more about the use of a valuation and getting your timing right.
Yeah. So similar to you, we've all got our own, I won't use checkered, but we've got a past and experience. And I think a lot of people on the call have, live in the world of valuations. And I think the key thing for us is having experienced the number of transactions we have, and I suppose the valuation process as often as we have, is you get a very good feel for what the market values and how it values and what those drivers are. And interestingly enough, the ability to do a valuation that is played back according to almost that checklist is really important. But what we've learned, and hence why we've evolved into what we call our valuation plus process and product, is that it's almost a eyeglass, if you like, or prism looking into the business, because through going through that process, it spits out all the good stuff, all the not so good stuff, the value drivers, the risks and gaps in many other parts of the business that you may think aren't important to do a good deal, but it turns out that they are. So starting with that process, and obviously how you do it and how comprehensively you do it, both at a quantitative and qualitative level, you'll be very surprised how that almost brings to a head all the moving parts that could have a real impact on being market ready and hopefully getting the right deal when one is ready. So and from there, clearly you flesh it out into how we approach it and where would you find the buyers. But I think what is very important in any valuation, historically, and depending on what it's required for, a valuation you're doing for the bank is very different to a valuation you're going to be doing when one approaches the market. And that context is important because it's based on a set of assumptions today. An important part is what's actually happening in the market. And I think from the benefit we have and the value we can add to our clients is that is always our North Star. What is happening in the market? Where is the pricing in the market? And then we can reverse engineer it into these are the elements that the market is looking for to drive value. So yeah, it's become an exceptionally powerful, almost strategic tool, if you like, outside of purely understanding what my business is worth today. It's where to from here and how do I make it worth more?
Just an interesting question, and I think we sound like economists sometimes because it's there's so many truths and there's so many not truths, but you can debate everything. But we've had situations where a company has been fairly sort of medium growth, and then they have a bumper year. Well, is that the right time to sell? Or they've been growing really nice and they've had one bad year. Is that a bad time to sell? So what do you think? How do you deal with those optics, Andrew, in terms of, does that, if you've just had a great year, is that a good time? And conversely, if you've had good years and you've just had a bit of a bad year, is that really a bad time? Or can one work that out through a market engagement?
Yeah, look, I think you opened up with it. There's never a perfect time to sell. And I think what one has to always overlay is why. Why did you have a bumper year, or why did you have a tough year? And I think that's a big, misconception in the marketplace around, that trajectory, whatever it's going to look like, defines the right or wrong time to sell. And I think through proper in-depth analysis, it's the story behind, why it's happening. If you're on a downward trajectory or you've had a cracker, year, whatever it is, remember, buyers look for a longer term. It's not 1 year, it's not 2 years, it's 5 years, it's 10 years, whatever that may be. But again, it's why, and I think only through the right level of work and understanding, measurement back to the marketplace and and understanding the building blocks of your business, you know, can one decide whether it's the right time or not. And yeah, it may map out if you've had a tough year and it looks like the next year is going to be tough as well, to say, look, it's going to be tough, wait it out, but focus on these areas, because when the recovery comes, then you've got a plan. And I think coming out of that, irrespective of what that trajectory looks like, is most business owners don't have a plan. They don't have a plan around what to do, what to focus on, what brings value, what doesn't. And it brings in that level of discipline, you know, but what we like about it, and you know, the feedback we got from our clients, what they love about it is it gives you this roadmap. But it's a roadmap based on reality, you know, and not the theory of, you know, a book you and I read last week and we think it's going to be great to implement it. So there's a time and place for that stuff. But I think, you know, having that plan and understanding why, you know, and we've got it now. We've actually got it now in a live deal where they've had one tough year. And it's very interesting to see, because the fundamentals are right in the other areas, it's actually not diluting the value, because, you know, the forward-looking element is good, but the rest of the business is solid. And the team is solid. So yeah, there's a lot of learnings that come out of that, irrespective of what your business is doing.
Going back to the topic, you know, when's the right time to sell? Certainly for them, I think in that particular case, now is exactly the right time.
Yeah.
Because if they happen to have another tough year, now that'll become a trend.
Agreed.
So they've got to get into the market quickly. In other scenarios where maybe the trend isn't good, rather go and work out how to turn that trend around.
Correct.
You know, we so often find companies where we can see the value. We can see the value, and it's limping along. You can't, you know, what's the definition of insanity? You can't keep doing the same thing expecting a different result.
Yeah.
Sometimes you've got to go and figure out how to get the different result.
Agreed.
And you've got to go and implement it, but implement it within a time frame with a goal of an exit. Sure, that may need to be 2 to 3 years. Sometimes it's a lot less, because as soon as you, sometimes fixing the fundamentals actually really shortens that time to being able to demonstrate to the right acquirer, here's the value. And we can get better value than we were doing, because we were limping along as a, maybe not limping, but we were a lifestyle business. We made a decision to make ourselves more attractive by cleaning up a whole lot of things. And now look at the growth that we demonstrate.
I think one of the areas, you know, about when is that the right time to sell? You know, I had a conversation yesterday actually with a potential client, and the starting point is, well, when do you want to be out? You know, so that's where you've also got to separate the individual from the actual business. So well, I want to be out in 5 years. So, well, you know, it's going to take you a year or two to sell, and you're going to have to stick around, you know, for 3 years, whatever it is. So your 5 years are there already. And you know, that in isolation of whether the business is ready is, you know, it's quite schizophrenic to try and figure out how does all of this tie together. So you know, it's to start getting some facts on the table. You know, there's a lot of speculation. There's lots of stories around someone who knows someone, and you know, these types of things. There is never a perfect time. However, there's perfectly prepared and perfectly ready. You know, and I think that, you know, you've got to focus on what you can control. I think for the business owners on this webinar as well, is being ready and kind of, you know, being ready to approach the market means you've fundamentally got a good business. So whether you sell or not, it's okay. You've improved the quality of your business. You know, and that's why we absolutely steer away from window dressing and, you know, getting ready for the ball, slap some lipstick on, and hopefully we can make this thing work. So that, you know, it's almost sound business practice that gets you there. And ironically, you know, we've got 1 or 2 cases recently where that process actually made the business, we found more profits at one level, and it added to the multiple because there was a more sustainable story to be able to support the valuation.
And I think that, you know, going to the, you know, in the points that we put into our invitation, the first bullet was, you know, the pitfalls of a passive approach. You really need to look at your business through an acquirer's eyes and present it in that way when you take it to the market, or you've got an acquirer at the gate. Present it correctly, because as Andrew says, often when you take a proactive approach, we invariably find more profit than we were expecting, firstly. And when you position it for the acquirers you're going to approach, you know, just a kind of reminder about our approach, we're not about doing a valuation and saying, well, who's got the money, who's going to buy this business for this price. We do the valuation, we understand the business, and then we work out in whose hands is this business going to be most valuable, and do they have money, and is there a good fit? Well, those are the guys that we want to dress this business up. And that often changes your thinking a bit, because now once you understand where your buyers are likely to be, you can also change your strategy and your business as to how you want to get it right. So absolutely, you know, we obviously, I mean, this is what we do, maybe not that obvious, but that passive approach of kind of waiting and seeing just goes wrong. You land up in a corner quite quickly. You land up with being controlled by the acquirer and not having control over that process. So to some extent, when's the right time? It's how long does it take to prepare? So you've got to do that. So that's probably that's the shortest time to between now and when you're ready to sell. But it is about being proactive. It is about looking at your business through a different set of eyes. And then potentially implementing a 6-month, 12-month, 24-month plan to be absolutely ready for that, for the best deal. And you know, so often, Andrew, I don't know if you'd agree with this, maybe you've got some stories to tell around it. If I rush out now and sell and say I'm going to market now, chances are, because of all the uncertainty that people will see quite quickly, I'm going to have to sign some kind of agreement which has a 2 to 3 year structure in my deal. If I waited a year, did a whole lot of the right things, chances are I've got my business a lot more sale ready, and I only have to stick around for 18 months or a year. So in a way, by managing the decision now and doing the right things now, you shorten the amount of time this deal's really going to take place. Interesting. So before you tell us your story, I've got a quick story. We've got a great client. They remanufacture in the diesel engine business. We met them a few years ago, and we kind of rushed to market. They wanted to get out immediately, and we got a deal that was a bit soft. The valuation wasn't there, just didn't really work. But we spent a lot of time seeing if we could close that deal. But in the meantime, they were doing all the things that they realized they needed to do with the business. They were bringing in succession. They were moving themselves a layer up in the business, bringing a layer below them. And sure enough, that didn't work. We went back to market at the beginning of this year. We closed the deal so fast. They're probably maybe 6 weeks away from final close on a 110 million rand deal. So yeah, you just getting that timing right and doing the right thing in the right time is critical. Sorry, Andrew.
No, it's good. It's a great example, and there's other examples. I think something that a lot of advisors, brokers, whatever it may be, get wrong in the market is, and we used to fall in that trap years ago, was the market will sort it out. The process will sort it out, and all it does is bring in variables and risk for any buyer. So all of those elements that are lacking, all of the fundamentals that aren't in place, definitely has a huge bearing on the nature of the deal. So in other words, you're not going to get your money on day one, because buyers are always saying, like, what am I missing here? What else hasn't come out? There could be tax implications, the way the buyer buys the business, so buys the assets versus the shares, as well as the individual business owner, your timeline, because they're not going to let you go quickly, because what else is going to come out of it. And I think that's the big learning. So a year in that example may seem like a long time, but it's fundamentally shifted the probability of success, and has had a huge impact on the value of that business. So that's a big part of it as well.
And just to the next bullet, the key elements of a strategic plan. I mean, this is, there are a whole lot of elements to it. Now, I think that the key thing is there's a difference between I just want to grow my business and I want to get my business ready for an exit. What's the difference between those? What are we looking at here when we talk about a strategic exit plan as against just a strategic growth plan?
Yeah, so look, I think a strategic growth plan is quite generic, and it's based on almost as many elements that are not controllable versus that are controllable. And our experience, I mean, I used to be in this game years ago in a previous life, and it is quite generic, based on a whole lot of what ifs, almost like a mind map. I think a strategic plan, or we probably prefer the term like that roadmap, is how do you join the dots around what are the key things that are going to be important. And a generic strategic plan normally involves a whole lot of change. A roadmap doesn't necessarily, when you're getting ready for strategic exit, doesn't necessarily mean a whole lot of change. It's refinement. It's getting a whole lot of building blocks in place and getting the stories right. But I think that the starting point is, it plays back to you how the market sees your business and where are their real risks. So is it customer concentration? Is it whatever? There's a whole lot of moving parts. But I think that the big difference with a plan, a strategic plan to exit, or that roadmap, is it's finite, it's actionable, and it's controllable. I think a generic strategic growth plan is, how long is a piece of string, and let's ultimately get there. But I think there's a lot more out of your control and probably a lot more dependent on the market itself. And I think that for us, that's a big difference, and hence why we stick to our knitting, which is the stuff that the market wants to see.
And I think it is about what we typically see in the world of privately owned companies. The classic is the real messy money stuff, where sure, this company makes me a lot of money, but you're not going to see it because I don't want the tax man to see it, so I'm going to make sure you don't see it either. That's hard to sell. We can do it. One can do add backs, and you can structure it correctly and present it and have a schedule of all the costs that have gone through the business and why the profit is X, not Y. But if you've got some time, maybe you should tidy that up. I think, again, balance sheet structuring is a great thing to do. It doesn't take much. Just get the balance sheet right, get the balance. There's a tendency among private business owners to never use debt, always tend to be overstocked, and generally have a fairly lazy balance sheet. Well, maybe there's something you can do there to change that, and change that profile. Just some examples. This messy money thing is a term we've just recently come up with. And if you're a messy money company, how do you get to that get yourself to presentable profits? I think we all intuitively know what that means, but what are the actual building blocks that you've got to do, and you've got to build and put together in order to get you to that presentable profits? And I think maybe, Andrew, you can pick this one up. We're not trying to say to people that they've got to become corporatized and perfect and polished and basically as good as a listed company. What do we really say?
I think the starting point is your numbers accurately represent your business, because I think in a lot of privately owned businesses, and we've got lots of examples that I'm going to say the messiness, your messy money analogy, the looseness of the reporting, the governance structure, all of those things make it very difficult for a buyer to audit in a due diligence. So this isn't now becoming, you've got to set up an audit committee and formal board meetings and a company secretary and all of those elements. This is just around building and creating a robust framework, if you like, that can give a buyer confidence in various elements of your business. So this isn't, re-engineering the entire business. It's some refinement, it's some focus. And kind of like what we said, that starting point, when you do the right type of valuation, it highlights where are some of those gaps. It's going to highlight where are some of the areas that a buyer is going to look at when they want to conclude a successful deal, and give a green tick for due diligence. A lot of the time, you get to the due diligence, and it's the first time business owners are being asked for certain things. And then it's just panic stations. So this isn't going to the other extreme, where now you're going to have to hire a whole admin department just to manage all of this, these moving parts. It's simple tweaks, and I think that's what we're going for here. We're going for simple tweaks to make sure that what shows up in the due diligence accurately reflects what you've built, and that both of those align to what the right value and deal structure is going to look like. Because it's definitely not corporatizing. That in itself is a whole different debate.
And that's a massive buy and build kind of model that the private equity guys are very good at. There are cases where it can be done, but I think generally, the market is looking for privately owned businesses. Often a lot of value opportunity for somebody who comes in with a new strategy and build. We're not necessarily going there, but sometimes you want to. If you've got a 5-year time horizon, absolutely go for gold. If you've got a 1 or 2 and you really want to get this done, then keep it simple, as Andrew says.
It's quite interesting, just on that note very quickly, so Rick, is because that is the value. I mean, we've got some financial investors on this webinar as well. That is a big part of the value that they bring to the table. So if you're a business and you're in a good place around being market ready and whatever it is, then buyers are going to look for growth. And what the roadmap does is, okay, well, let's focus on growth. Where to from here? Why would somebody invest? So you may remove some of the lower hanging fruit that the right investor could help you clean up, but now the focus is completely on the right stuff, and then you align, and so, because if you've got all the boxes ticked in a great financial reporting system, but you haven't got sufficient focus on where you're going and the growth, where the growth is going to come from, you're not going to do a good deal. So it's almost a zero-sum game where irrespective of who's coming to the table, all of those ducks are in a row that hopefully it can optimize your deal.
Well, I think as we get near the wrap up, I just want to go back to the market. And funny enough, well, not funny enough, I do this quite often. I was on a run yesterday morning and running with someone, and they said, so, how are you finding the markets at the moment? And I said, well, it's quite difficult to answer that very quickly because there's such a lag in the process that the deals we're doing now were done a year ago or 6 months ago. So they're not an accurate read. But what we are seeing in the market is, and I think a lot of business people have seen this, is just a very, very positive sentiment, coming out of the last elections. Generally a focus, no more load shedding, apparently. Well, that's good news. So a lot of good fundamentals in place. And I think that's coming through in the investor sentiment. We had a great report out from Deloitte that we were looking at yesterday. In every single area across, and this is across Africa, the sentiment is strong. There's an expectation of an increase in investments. There's an expectation of more cash available. There's an expectation of more private equity activity and offload activity. So there's no doubt that the next period, and I'm hoping that means a period of 18 months to 2 years to 3 years, is going to be a great time for selling businesses, and it's going to be a great time for buyers to be active because they can buy great businesses that are going to be doing well. So from a generic market point of view, the timing is good. But remember, to start today, even if you're the most efficient sale process ever, you're only selling in 9 months to a year's time. Maybe something changes. So you don't try to time the market, but I reckon you can be confident or just have a good feeling about the market's in a positive place, and how do you take advantage of that market. Absolutely. And I tell you, one thing for certain is don't be passive, do it properly and engage the market properly. Andrew, I just want to check if we got any questions, or I don't know if we've got it. We can add a few more minutes if people do want to load some questions into the Q&A, and we can pick them up there.
Absolutely. And, something that's come up recently, in fact, it happened this week, was there's the market, and then it's who you work with, in the market and whatever it may be, and I think the key for any business owner, hence why we talk about this topic, is don't be impatient. Don't, and don't be told that you can just go to market. It's always important to understand, are you ready to go to market? And, the take that step back, because unfortunately, it's probably one of those times where you've really only got probably one shot to get it right. If you don't, it comes with a whole lot of other risk and brand dilution and the likes. But I think if you are, whether it's us or anybody else, just be very cognizant of probing to say, am I ready? Because I think more often than not, one just purely looks at the profit number or your turnover number, or whatever that may be. There's so many more layers to that, and and we've worked really hard to try and learn from buyers, and we learn every day on every deal, every buyer we talk to, on what is it that buyers are looking for. Yes, there's the financial metrics, and we understand that, but there's so many more layers to that. So make sure you're going in eyes wide open, because it can be a very misleading journey from your perspective, and it's exhausting. It really is, and it takes its toll. So yeah, just that one caveat is really important. Probe, and for you as the business owner, understand what are those things that that are going to make it a successful deal, that are going to make you business or market ready to to execute effectively. Andrew,
a question has come through around succession. Basically, how important is succession?
Yeah.
And what are your thoughts on that?
Yeah, look, I think succession is critical. I think, unfortunately, most business owners aren't great at it. And I think there's some of our clients that have been, I'm going to say, successful in building a successor team, not replacing the business owner. Because I always say the business owner's successor's got their own business already. So part of it is if you don't have it, ideally try and have a plan, or be cognizant of it. And if you haven't got succession in play, I think the only variable is a buyer's going to expect you to stay on a longer period to help put that in place. But I think as a responsible business owner, it's something to consider, because if you don't sell your business and God forbid something happens tomorrow, what is there a team that that you can build? And I think that's a very, very important mind shift that every business owner should be looking at. Are you self-employed, or are you building a business? You build a business, you're not in it, or you play a very different role in it. So yeah, but it is, if you think about it, people work with people. Acquirers generally back people. So if they're going to back you and you alone, that comes with a risk profile for them. If they're going to back you and a team around you, that mitigates some of that risk profile. So yeah, it's definitely something that needs to be tackled sooner rather than later. And when I say, as I mentioned, tackle, it doesn't have to be solved. It's just, you've got to start tackling it.
Just another interesting question came through here. So now I've got, sorry, another question just came through on succession. So hopefully we've answered that, David, to cover that one. Maybe, as you say, well, let me put David's question forward because it is slightly different. What about family succession? How do we deal with the big family business where there's an expectation of flowing that through to the family? But of course, dad wants out or granddad wants out. How does this? How do you solve that in a sale process and readiness?
Yeah, it's a really tough one, and it's tough, and we can only base it on our own experience. We've only had that I recall maybe 2 or 3 deals out of however many where there's been successful succession between the 2 generations. I think your challenge is what is the skill set, as a starting point, and what does succession actually mean? So part of it is a name and a pedigree and whatever it may be. The rest is what is the size of the business and the skill set required. Because we're, at the end of the day, as you pass down, we've actually got a very real situation where the father's built a very successful business. The son is in the business, but he's not the replacement CEO. He's still there. He's a minority shareholder, but he's not the right person to lead that business into the next phase. And that's part of the tough conversations and tough analysis one has to do. So yeah, family, if the skills are there, great. Family for family's sake can be a risk, and buyers will see through that. They want to back the right jockeys who are going to help them grow this business to the next level. It's not necessarily they want to back a jockey that's got the same surname. So yeah, it's a tough one, and the success rate's even lower with family succession.
Interestingly, now this is actually, I think, a great story around the succession topic. We once had an article written, I think it's Andrew, actually, you might have written it, around succession, and it landed up in the Report newspaper. I think it was translated into Afrikaans, which Andrew's not a strong point, but he's okay. And this was picked up by a family business in Bloemfontein called Herald's Electrical. And this is their challenge. A lot of family members, all in the business, no one putting their hand up to kind of stay, everyone wanting to get their money out, but at the same time, a sort of a family legacy. And yeah, we landed up, I mean, that was I think our first deal north of 400 million. It put us on the map as from an advisory perspective. But what was so fascinating was how things changed as that went along. Everyone said they wanted out. In the end, we got in a really powerful private equity player, sort of French-based or Mauritius-based French money, and two of the sons stayed in the business. They kept a share at sort of 22%, I think, and they've probably grown that to almost the value of what the business was originally, alongside a great private equity partner. And what's interesting about private equity actually is that sometimes there's an opportunity to buy back those shares and make it back into a family business, depending on how you do it. So I think family succession doesn't preclude the option of bringing in equity partners. There are the right deals out there, but it does make it critical that you go to market properly and find out what the market really thinks before you just make an assumption about what the market is going to think. I think that probably covers that, and it probably covers our time as well. Any other topics, any closing topics you want to raise, Andrew?
Yeah, no. I just think, I was kind of asked for that analogy around, when we map out that roadmap, to, reflecting what we see in the market itself. And it's important, and I go back to that earlier point around understanding, you'll be surprised what drives value and what detracts from value. And you've got to have a plan. I think the one thing is in line with this topic is you've got time, but you don't have time. Like, again, to sound like an economist, it's so, it's quite a strong juxtaposition, but it's you've got time if you're doing the right things. You don't have time if you're not. And I think what we're trying to do is help business owners identify and do something about the right things. And then you've got choice, and if you decide not to do anything, then you've got a better business, so that, that's that. And again, thank you to everybody for your time. It's been a great discussion.
I've seen a great question. We can't stop now.
Okay, cool.
What is our view on business coaches, and do they solve the problem?
Yes, so it's a good one. It's interesting. I actually just got a referral from a business coach. It depends what the problem is, and I think, again, it's it's a situation of what are you focusing on. If you go to the business coach is going to be focusing on, are you ready to sell? Is that are you ready as the business owner? Have you got succession? Whatever it may be. So there's definitely a place to grow a business and get there. I think why we are fortunate is most of those business coaches have never sold a business. While they may have sold a business and now they're coaching, they aren't speaking to the business all day, every day of the year, and understanding what is actually happening around what's driving value and not. So, I always, I suppose I use it this morning with the team, use the analogy of a GP versus a specialist surgeon. I think there's a place for coaches, and I think that's more of a generalist approach. I think if you're seriously looking at an exit strategy, we would sit in between the two, because it is different, and I think until such time as, you sitting in the trenches with buyers, reflecting back on what's good, what's bad, or all of those elements, you just don't know. And yeah, so I think that's why we do what we do and why that part of our business is growing. I think coaches take you to a point. I think we, what we do, and this element is the catalyst to, having a successful deal or not. And I think that's
roadmap to market readiness, I think, is what it comes down to.
Yeah.
Good question. Andrew, thank you very much. Who's been watching, thank you. Hopefully, well, I know some people